A very good evening to everyone. It's currently 5 minutes past 7 and we shall begin. I'm Yang Yao, the co-chairperson for the Eurasia Asset Management Challenge, an annual case competition organized by NTU's Investment Interactive Club. We are proud to be sponsored by iFast and FSM1 for the second year running. Tonight, we are pleased to invite them to give a general education session to expand our financial knowledge. NTU Investment Interactive Club is an academic club for the undergraduate population in Nanyang Technological University. Founded in 1999, the club was set up to develop a vibrant investing community and is the largest finance society in NTU today. Towards a knowledgeable investing student population, IIC aims to promote greater financial literacy among young students and develop their interest in finance by assisting them to develop and further hone practical investing skills with a stimulating learning environment. FSM1.com is the online investment platform of iFast Financial Private Limited, the Singapore subsidiary of the SGX Security Traded mainboard listed iFast Corporation Limited. With an FSM1 account, DIY investors can invest into a comprehensive range of investment products and services, including over 1,600 funds, 900 bonds, FSM managed portfolios, stocks and ETFs listed on Singapore, Hong Kong, and US exchanges, as well as insurance products and estate planning services. FSM1.com has various research teams, portfolio managers, and content writers who take a close watch on different markets and products to help investors zoom in on investment ideas. It also offers various investment tools on its website and mobile application to help investors make informed investment decisions. The investor community can visit the FSM1.com website for their transactional and investment information needs.
Thank you, Yang Yao, for the brief introduction. Hello, I'm Lim Te, the other co-chairperson of NTU-IIC EMC. So our first speaker will be Colin Low, who is a macro analyst with the iFast Research and Portfolio Management team. He is responsible for the analysis and research coverage of global markets and the generation of actionable market views for various asset classes. Colin is also a part of the portfolio management team that manages FSM MAP's discretionary investment portfolios. He's responsible for the development and implementation of strategies across all the portfolios and his product selection across both fixed income and equities. Colin started his investment career as an analyst covering emerging markets in multiple regions, such as Russia, Brazil, and Indonesia. His experience in such dynamic and volatile growth markets strengthened his investment philosophy and strategy, long-term and value-driven research. Colin frequently communicates his views about and the team's strategy to the local media, including 联合早报, Money FM, and 96.3 FM. He holds a bachelor degree in economics from the Singapore Management University. Today, we are happy to have him here with us to share more about portfolio management. Colin, please.
Hi, good evening, everybody. So let me share my slides and we can begin. All right, I think so you can see from here. So today I'll be covering the basic principles of portfolio management. So I think this is a very short crash course as well as some basic highlights on the essentials of the portfolio management as well as some of these best practices. So I will make it, I've distilled some of these key points into these slides and I think I'll make it quite short. So if there's any doubts or any questions, feel free to raise them up in the end Q&A. But I think without further ado, let us begin. So moving to my first slide, as you can see from the performance of the equity markets over the last year, you can clearly see that markets can be volatile. And last year was a prime example where investors' emotions were being toyed with throughout the year. So at the start, we saw COVID-19 pandemic spread rather viciously across the world and equity markets were hit hard and fast. So that plunge itself has taken some people by surprise. And as fast as it falls, it actually rebounded when the Fed announced this QE. So this swift recovery sort of followed quickly afterwards. So in between the next couple of quarters, we see the cocktail of your reopening news, your vaccine news, as well as your virus resurgent news. All this interplays and continue to toy with investors' emotions. So that period can be hard for investors as well. And nearing to the end of the year, we saw the US election, which again swung from the right to the left, and eventually we see a blue wave coming out. So I think that also causes some of the tensions as well as sentiments fluctuations within the market. So broadly speaking, last year is a good example whereby markets can be volatile and can play with investors' emotions. And therefore, to really curb this emotion, there is a need for a solid framework for investing. So I think there are some key principles I would like to highlight just to put everything into place and help investors to tackle these emotions and how to better manage their own portfolio. So I think the first key management principle is coming from an asset allocation perspective. And the second one is coming from a diversification perspective. And the last but certainly not least is a review and rebalancing perspective. So I think this broadly covers most of the essentials, but bear in mind, I think portfolio management is a skill that is of course also an art that continues to evolve as we go along. So these are just some primary levels of framework, but certainly it doesn't cover the entire core principles of our portfolio management. So I think let's dive into the first principle. So for asset allocation, how we look at stuff is from an IFRS perspective is we look at it from both an inter-asset as well as an intra-asset allocation. And of course, a portfolio itself can be purely focused on one asset class, where it can be a full equity, a long-only portfolio, or a fixed income portfolio for that matter. So at IFAS, we approach it in a diversification perspective where we have various asset class within our portfolio. So as an example, for inter-asset allocation, we see different kinds of asset classes such as your equities, your fixed income, your cash, as well as some of these alternative assets such as your commodities, your real estate, etc. So investors can definitely put them into their portfolio, and within each of these asset class, they can further divide it into regions or even countries, and for your commodities as well as your fixed income can be even into different sectors as well. So I think inter as well as intra-asset allocation are important when it comes to how you are going to invest in an asset and allocate your asset exposure to a certain geography or to a certain asset class. So for inter-asset allocation, I think from IFA's perspective, we have two different asset class within. So number one is equities and number two is bonds. So here is a simple example of 5 different portfolios for 5 different risk profile. So finding a risk profile for yourself is definitely important when it comes to portfolio management, as it will determine what is the level of how you are going to split the asset class within the portfolio. So for our case, things are a little bit more simple where we only have 2 asset class, but for some of the investors, they can include the different asset classes, like I mentioned earlier, like your commodities, and within that space, there is different intra sectors. So these are all the neutral allocation, whereby it is the default breakdown of the asset class allocation within the portfolio. So essentially, this is the DNA of the portfolio. So as you can see, for very conservative investors, we do have a higher weightage in bonds, while for the very aggressive investors, we have a higher weightage in equities. And certainly for the balanced investors, so investors will have not really a risk preference, then we have a balanced portfolio where it consists of 50% equities and 50% bonds. So take for example, how to determine what is the higher weightage definitely falls down to risk preference, and therefore one can look at things such as your volatility, and when it comes to screening of the asset class, the different ratios such as your Sortino, your Sharpe ratio, to determine how volatile the asset class is and how correlated it is to the other asset class. So within through that practice, you can determine whether you should have higher overweight for the more risky asset class, and or have a lower weight to the less risky asset class. So once again, this asset class itself is not static. It is dynamic, as views can change over time, and this therefore leads to a different weightage of your assets over time. So in this case, take for example, if you have a favorable view on equities over fixed income, you may want to express an overweight for equities. So as I mentioned earlier, the balanced portfolio, for example, is a 50-50 split. So if you are to express a favorable view for equities, you might raise that up, or might bump that allocation up to 65% and reducing the weightage for fixed income. Well, so there isn't any hard guidelines as to how much you can overweight, but our recommendation is not to go too much of an overweight. Keep the overweight low, because you do not want to shift from one risk profile to the other risk profile when you try to overweight one of your asset class. For example, equities, you do not want to move from a balanced to a moderately aggressive risk profile, and therefore it's a keynote to remember when you try to overweight your particular asset class. And to determine how much is to overweight, you can also look at you can run some backtests. You can look at what happens to your overall risk profile when you overweight a particular asset class. So you might run your Sharpe ratio, your Sortino ratio. You can look at the maximum drawdown and look at stuff such as that, and having a more quantitative metrics to see how much you should exactly overweight, and that should be the optimal overweight for your portfolio. So for us, I think we comfortably stick to a overweight of a maximum of 15% up and down. So I think that is still within our comfort range, and we think that works best for us. So the same can be said for the opposite, which is the whole having a favorable view of the other asset class. So the practice is still the same in general. So when it comes to intra-asset allocation wise, there are many ways for intra-asset allocation. For example, you can split it by style, you can split it by size, your large cap, small cap, you can split it by geographical. So for us, we allocate primarily by a geographical exposure, and that expresses able to express our global macro outlook, as well as some of the themes clearer. So I will talk a little bit more on this portion later on. But the key idea here is the idea of diversification. So I think there is a saying that diversification is the only free lunch in the investing world. So I think that is true to a large extent, because diversification helps us to hedge the exposure from, for example, from a wrong country from a wrong timing. So it also helps us avoiding home bias when it comes to a geographical exposure. So overall, it able to protect us from the outside loss. Because if you are to stick to a home market over time, you might find that, hey, you might get a better return at certain periods of time, but when certain macro catalyst aligns, you might find that you might find yourself on the wrong side of stuff, and you might see a greater drawdown. So it's therefore good in a general sense to avoid the home bias, and having a diversification also helps to curtail that home bias. So moving on to within the equity allocation itself, for us, we use a GDP weighted methodology for our neutral positioning, and we find that having a lesser concentration as well as having a better diversification across the different equity markets helps us, especially when it compared against a market cap weighting. So for example, a market cap weighting may find a larger allocation to US equities as well as the European equities. However, if you were to look at things from a GDP weighted methodology, whereby the weightage itself is in proportion to its contribution to GDP, and you will find a lesser US allocation while having a larger Asia ex-Japan allocation. And this allows a more balanced as well as a less concentrated allocation across your portfolio. And of course, this allocation itself is reviewed frequently to reflect the realities of a changing world. So what this means is, while you carve out the different allocation, it is also good to carve it with a forward-looking perspective. So it is you shouldn't simply look at how much the contribution to GDP is for this year as well as the past few years, but rather look forward and look at how much you think this particular region can grow and can account for the future weights. So take, for example, the case of China, so which is our China sleeve is one of the latest inclusion to our portfolio. So I think a lot of different global portfolios, allocation to China is quite underrepresented. And looking ahead, we feel that China is going to take up a larger percentage of the world's GDP, as I think this distinction is going to be much more clearer from after in a post-COVID world. And with regards to that, we decided to have to carve out a slot for China, because I think if you're be able to position ahead, we're able to capture that growth in the equity markets early, and therefore the portfolio will be able to benefit when it comes to a risk-adjusted return. And overall, adjusting for our overweight as well as underweight position on individual market is also largely based on your some of the key outlooks, such as your macro as well as the earnings outlook, your equity drivers, as well as your valuations. So I'll go through some of this selection process later on. And the same can be said for the bond markets. So we do have different exposure to major bond market segments or sectors. For some people, as well as those sectors are tailored across different regions. So broadly speaking, we split them up into a 65 and 35 credit barbell. So we have a larger allocation to safer bond markets. And a core reason for this is because we believe that having a larger weight towards the safer segments help us cushion our portfolio against the volatility in the equity markets. So we balance out that perspective. And at the same time, it provides diversification across the different assets, not just within its own asset class, but across the two assets. And because a simple reason is because it is not well correlated in the longer term, and therefore is able to have that kind of cushioning effect in our in our portfolio. So overall, you might find that stocks over the long run would have resulted in a higher return, but few investors could have sat through that bumpy ride, when it could have sat through that drawdown when it comes to, say, for example, when it comes to the 2008 crisis, the tech bubble, as well as the recent COVID crisis. So few investors could have sat through that and may have sold at the bottom of it, and never to capitalize on that low valuation perspective. So having a diversified portfolio helps in that regards, and helps to cushion that, and the importance of it stands out even more during drawdowns. So I think the next point I would like to make is that the asset allocation itself reflects your investment views and your outlook. So take, for example, for our portfolio right now, there are several key macro themes that we see that is supporting our strategy for the year. So I think these four key themes are laid out in the slides here. So we see a robust EPS recovery, supportive policy backdrop, macro recovery, as well as a milder risk backdrop overall. So what this means is that we think it is worth it, and it's worth it to be pro-risk as well as pro-cyclical for the year, and therefore we favor equities amongst other asset class. So to express that in our portfolio, we have an overweight for the higher beta regions, so regions such as your EM equities, your Asian ex-Japan equities, etc. And opposite of that, we are holding an underweight in some of the other key regions, such as your Japan equities and your digital economy, as well as the US high yield. So the essence of this is that your asset allocation should reflect your investment view as well as outlook, and again, to the point where it should be more forward-looking rather than looking at the current picture. So here is a simple example of a top-down selection methodology. So first, I think for investors looking at how to assemble their portfolio, I think a top-down selection methodology works brilliantly here. Firstly, they can look at the macro themes as well as the portfolio drivers, and with that, there are certain elements such as your economic, your policy, as well as your sentiments and flows that can narrow down which region you should be choosing. And finding out which region to choose is important, because you can have a more nuanced strategy, such as your DMs versus EMs, and which EMs should benefit, or having a single tilt versus a growth tilt. So that itself will influence the stock selection as well as a country selection. So moving to the country selection itself, then there can be more quantitative screening when it comes to that. So looking at metrics such as your sales, your earnings, some of the valuation metrics, as well as the relative growth of a particular country can help. And also, aside from looking just at the economics as well as the equity picture, you can also look at the FX picture as well as the bonds market. What are the signals that's telling investors for the particular country? So I think looking beyond that also helps. So, and last but certainly not least, if your portfolio consists of stocks, you may move down even more and look at stock selection strategy. So with regards to that, you can look at some of the fundamental analysis or even add in the qualitative screening such as your comparative advantage. So, but bear in mind, this is just a very simple top-down selection methodology for equity markets. But the overall principle can definitely be transferred to bond markets as well, but with different modifications, so to speak. And moving on to diversification, which I have alluded earlier. So I think to note here is that in this ever-changing world, rarely does one asset class perform consistently, especially over the past business cycle. So here you can see the top asset class that performs strongly is China as well as digital economy. But the year prior to that, I think the picture is quite different. So I think with that said, I think forward thinking needs to be exercised when we are practicing diversification. So I think a key thing to note is the macro backdrop as well as the backdrop or just the policy and macro backdrop of what is going to happen. And take, for example, the case of a new normal in the post-COVID world. So we see in the slides here, there are 7 new trends arising. And for example, the shift to telecommunicating, the adoption of e-commerce, as well as the rise of digital health, etc. So all these are new factors. So when it comes to new factors, therefore, there is a need to change the portfolio as the world evolves. So I'm going to give an example here that we did for our portfolio. So we recently implemented as a sleeve within the equity allocation, which is for the digital economy. So these are the internet economy stocks. So if you were to look at digital economy as a national economy, you'll find that it is in fact the third largest economy in the world. So just behind US and China and in front of Japan and Germany. So those are the economic powerhouses that have been the mainstay for the past few decades. So digital economy is a rising and a growing economy. And we see that, and therefore I think there's a need to include a sleeve for it within our portfolio. So again, if we were to take one step further, we can even introduce a tactical allocation sleeve. So on top of your core allocation sleeve, so we can introduce this tactical allocation sleeve to take advantage of these changes in the global economy. So for example, let me show here. For example, here we have on the left hand side, we have a core allocation. So these are more of a longer term, medium to longer term views for some of these economies, and therefore the weightage of the particular regions as well as the economies are as such. So here you can see the digital economy stands to be about 10%. So in that itself is in proportion with its contribution to the global GDP. So having seen the rise of a digitalized world as well as, like I mentioned, the new normal after COVID, we saw a need to implement digital economy into our core allocation, meaning we saw a very positive medium to longer term outlook for digital economy as a whole, and therefore we believe it deserves to be within the core portfolio. However, at the same time, we want to make certain other adjustments without disrupting the core of our portfolio, and therefore we implement this supplementary portfolio, which is our tactical allocation. And this portfolio itself is supposed to be tapping on some of the best ideas we have and some of these higher conviction ideas. So for example, here we have semicons, global financials, as well as China technology. And again, within this tactical portfolio itself, tactical sleeve itself can be just a small percentage within the overall portfolio. So for our case, we have it at a maximum of 20% of the equity sleeve. So 20% of the overall equity sleeve. So here itself shows some of these examples of tactical portfolios for investors. So tactical ideas in a portfolio are just some of these high conviction ideas that you believe are able to generate the additional alpha to help to contribute to performance. So here you have the traditional ideas such as your green technology, your semicons, your healthcare. But of course, you can add in single stock idea. Maybe you favor GME, you can add in that as well. You favor commodities, you can add in silver, you can add in gold. So you can add in even certain ideas such as your hedging ideas, for example, for if you're long emerging markets, you can short your longer end of a treasury as a form of hedge. So that itself can be under the tactical ideas. But overall, the key message here is that a satellite portfolio allows for conviction ideas to be expressed more succinctly, and therefore I think the need for a satellite portfolio is definitely rising in today's world, and definitely this satellite portfolio itself, as we backtested, have seen to be able to contribute to our alpha or our performance over a longer term picture. And moving on to my last few slides. So there is definitely a need for reviewing and rebalancing. So the key message for this is that a review and rebalancing is essential for a portfolio to stay true to its original objective. So starting from a monitoring level, a regular review of portfolio positioning helps in the longer run, and adjusting the portfolio to reflect the market views is able to capitalize on that timing perspective. And also another thing about portfolio management, a crucial element of portfolio management is definitely having your risk limits and having your risk management in place. So ongoing monitoring of your investment limits, your restriction, as well as some of this your risk metrics is able to help in the longer term to mitigate the maximum drawdown. Because if the larger your hit, the more you may got to recover that loss you had sustained for the portfolio. So we think a good risk limit or risk management profile is able to help in the longer term picture of that portfolio. And lastly, having a rebalancing schedule itself is also very helpful. So your portfolio target versus your actual returns may differ, and if there is a need to trigger rebalancing, then I think for investors as a whole, it should be done. It should be done rather swiftly, because the idea of rebalancing is to sell off the more expensive allocation, so allocation that have run off its neutral limit, and using that to buy into the cheaper exposure. So those exposure or allocation that have underperformed. So over the longer run, I think rebalancing itself is also a way to cut down your risk, but at the same time to take profits. So once again, I think let me just recap the 3 portfolio management principles before I end off. So I think I mentioned in detail on the asset allocation. So that this asset allocation is important when it comes to expressing your strategy for the portfolio. So a portfolio asset allocation can be split into your intra as well as your inter-asset allocation. And within that, you can express your strategies by having a tilt towards certain elements such as your value or your growth. So that itself can be expressed through your product selection, which can be a fund or ETF or even a single stock. So that is for asset allocation. And for diversification, I think I've mentioned it throughout the presentation how important it is. So essentially, it's like a free lunch in the investment world. So I think having a good portfolio diversification helps over the longer term picture. And while in the near term, some of this correlation between assets might be highly correlated, but generally, if you backtest it, you can see that in the longer term picture, some of this correlation might revert back to its historical norm. So I think having a strong portfolio diversification in terms of both intra as well as inter-asset allocation is definitely helpful. And last but certainly not least, having a plan to review as well as rebalance a portfolio on a regular level is also helpful when it comes to being able to take profits off the table, being able to mitigate the risk profile of the entire portfolio. So I think with that, I come to the end of my presentation.